Stocks have been rallying into the end of this year, but do you remember what happened last year on Christmas Eve? Yeah, it was a little bit of a scary time. Check this out. Since that drop, you're seeing just the end of it right there. Check out what has happened. The S&P is up more than 33%, I think actually 36% or even a little more. Joining us right now with a technical look at the markets is Chris Verrone. He's partner and head of technical analysis at Strategas Securities. Also, our guest host, Joe Lavorgna, is here, too. Chris, you see more bullish signals, even given the gains that we've seen since last Christmas Eve?
Yeah, I think what's remarkable is when you look at this business, price tends to lead data. And when we look at all the macro charts right now, whether it's steepening yield curves in U.S., in Germany, in Aussie, whether it's crude near a 52-week high, copper breaking out, I think this spells better growth in 2020. And I think the question is, yes, the market's up a lot off the low, but most markets around the world really haven't made a lot of progress over 2 years. So I think it's early to fade this.
Let's just put that for people who don't follow these charts frequently. Yeah. You look at things like oil and at crude because those markets would tend to figure out if demand's going to be up or down from here, right?
Yeah, I think they're significant in terms of global demand. And it's not just the macro pictures. The industrials, ex-Boeing, have actually been really good. The material stocks have started to firm. Semis have been leadership all year. So these conditional inputs that we look to for signal on whether growth is getting better or getting worse, I think point to an improvement in 2020 versus 19.
And that's exactly, I couldn't agree more with what Chris is saying, and Tom and I were talking about this offline about macro data lagging. Yeah. That there are some figures that are worthwhile, but the thing is the markets will have a way of endogenously, basically creating the wealth and the opportunities, and the financial conditions are so supportive that if you have high equity prices, a market that's underowned, curve is steepening, it's good for financials, industrials, cyclicals, and you actually get the better growth. So I couldn't agree with, you're spot on.
Well, we'll see. I think the parts of the world that in many respects have been most hated all decade, European banks, Japanese stocks, are actually those that are getting better here. And I think investors ought to look to them next year as areas of leadership.
What does that mean? You mentioned that a lot of these markets, a lot of these areas, like you just mentioned, haven't seen the gains to this point. What does that mean for a market like the U.S. equities market that has seen a lot of gains?
Well, I think it's a question of where leadership is going to come from next year. One of the things we did, we looked at the German PMI. When the German PMI is 40 or below, you want to be buying every European stock you can find.
Because it can't get any worse.
It can't get worse. What's the worst that happened? It goes from 40 to 38. Who cares at that point? So where do you have that? You have that in Hong Kong, you have it in Germany, you have it in Australia. Places that have been neglected over the last number of years, I think is where some of the gains in 2020 will be found.
Chris, I'm officially nervous. We've been on air now for 3 hours.
Nobody's had any pessimistic view.
It's just been a chorus of and nothing can go wrong.
Exactly.
Earnings are going to increase. Rates are going to stay stable. We're not going to have any big geopolitical issues. The S&P is going to go up another 10% next year. What could go wrong?
Is positioning as mature as people are talking right now? And I think that's the big question. I think what it means, if you look at the positioning data, do people own the right stuff? I think there's signs of excess in low-vol stocks, in yield stocks. Are there really signs of excess in the risk-on corners of the market?
Triple C's, high yield, but not equities.
So it's this debate of where is positioning excessive. If you look at the fund flows this year, the sectors with the most flows, staples, utilities, telcos. That is not the risk-on positioning that gets us worried. I recognize in the very short term here, put calls are very low. I think that can be a tactical risk. But let's not confuse a correction or a pause with a top. Most markets around the world are in good technical standing. I think trends have improved, and I think the macro charts are getting better.
A year ago on this set, the markets were going to hell, and everyone came on and said, things are terrible. 2019 is going to be a lousy year. Today feels like the opposite, which makes me nervous.
Well, it's the Fed pivot, though, Tom. That's the thing. I mean, these guys, gals, made such a big mistake last year by tightening rates, letting that balance sheet roll off, and now you've got the exact opposite. They're basically doing QE. They don't admit it. Rates are low, curve is steeper, and the positioning, as Chris was saying, is really on the risky type of names.
You know, I also think the S&P is up 27 or 28 this year, right? When you've looked historically, that's a first percentile type year. When you look at forward returns following that, they're actually better than you would expect. They're better than the historical average. I recognize it's an election year. You'll get a correction at some point. I don't want to confuse a correction with the end of this bull market. I don't believe this bull market's 10 years old.
So let's ask you an election question. Predicted has Bernie Sanders, Elizabeth Warren, 20% chance combined of being the next president of the United States. If it looks like they're going to win the nomination come March, April, May, What does that mean?
It means you buy March vol and you sell November vol, right? If you're going to get a bad election outcome in November, the market's going to figure it out long before me or you, and it's going to price it in a lot.
But that's what I mean. If there is going to be a bad thing that comes for the markets will figure it out first. What should investors be watching to see, like, oh boy?
I think the price signals are going to tell us, right? If we're going to get a very adverse outcome, we're going to start to see things like discretionary rollback over, copper rollback over. If this is truly about growth weakening in 2021, yield curve flatten. And I think until we get those price signals, because it was the price signals all this year that led the data. So until that reverses, I'm reluctant to take the other side here yet. Again, put calls are low. You can get a pause or consolidation, but the signs of a major top, I don't think, are in place.
What, if you're looking at a market that you think will be the best? You mentioned some of these European banks. What else do you think will be the markets that really take off, or the areas that really take off next year?
I love Japan here. Nikkei has been neglected for 3 decades. I think it's improving. You have the most stocks above their 200-day right now in the topics than you've had in about 4 or 5 years. When participation expands, it's bullish. The Japanese banks have also started to turn. The Japanese consumer and industrial stocks have all turned. I think that is a neglected area of the world. We surveyed about 700 investors last week what market they thought would be best over the next year. Japan was last on that list. So I think you have sentiment on your side there as well.
Joe, what are you kind of watching out for? What would be the bump in the road as far as you're concerned?
GDP 3%, unemployment at 3%, wages moving up toward 4%, and the Fed going, oh, my God.
Raising.
Well, I don't think they're going to raise, but you get that fear back in the market where the Fed's going to take the liquidity away.
I'll make it harder for you. I'll make it harder for you. Let's say you're right, and we get close to the election, and then Jay Powell has to decide whether he was going to raise rates right at a time where the president's going to be screaming to go the opposite way.
If the Fed's going to hike, it's going to be...
You're saying that...
Not before... my fear on the Fed is spring, when it's clear that some of the things Chris was talking about and the data that I'm projecting turns. It'll be the spring, summer. They're not going to move. They're not going to be raising rates in October, November of next year.